99% of cryptos will fail, because here's the harsh truth. Crypto needs to change. It needs to evolve, because what happened before clearly wasn't sustainable. And in order to reach a new future in crypto, a future I still fully believe in, we need to look critically at what happened over the past few years and how it created this crash. Only then you'll begin to realize that we've seen this all before. Part of the reason that everyone and their brother has been so eager to pile on and mock crypto in the past few weeks is because prior to this crash, crypto was having a bit of a moment, a hot crypto summer. And just a few years ago, words like crypto and NFTs were barely even breaking into the public consciousness, and things totally changed. Places accepted as payment, large investors placing huge bets, sporting arenas being renamed, Matt Damon, LeBron James, Larry David, all in crypto ads. There's a good chance that your neighbor or your weird cousin or your girlfriend's boyfriend's coworker, people who knew nothing about crypto just a few short years ago, were now forming a pincer movement, cornering you at parties, asking you about Bored Apes and blockchains. So don't be too hard on yourself if you invested and you're down right now, but be willing to understand why. This market turned into a kind of gold rush that led to exponential and frankly unsustainable growth in the space. At this moment, there are more than 19,000 cryptocurrencies in existence, operating on dozens and dozens of blockchains. Compare that to the approximately 180 fiat currencies that exist in the entire world. There's a huge gap here. And as we all know, not all coins are created equally. There's some currencies like Bitcoin, Ethereum, Cardano, Avalanche that pose a genuine public utility. Coins that have detailed white papers, a clear vision, and a credible roadmap for delivery. Coins that were designed for a purpose. And then we have all the shit coins, or copy and paste coins. We've all crossed paths with these coins that just come out of nowhere, possess no public utility, coins that were created with the express purpose of buying at one price and selling at another. And it gets confusing fast. By the way, if you want to have an investment community around you, other investors to chat to, so you don't have to feel like you're alone in this space, check out Fanova, link down in the description. Now, useless financial instruments are hardly anything new. Just think back to the collateralized debt obligations, also known as CDOs, the mass packaging of bad mortgage debt. All the top investment banks in the world were selling these investment stink bombs, and we all know how that turned out. Now let's be real, we don't need 18,000 coins. The purpose of crypto is utility, solve a problem, provide a digital currency or service that's free from government manipulation. It isn't about buying some cheap animal-themed coin at one price and selling it at another. You can go to the casino for that. Now, I want to say that I don't necessarily have any problems with meme coins. I just think they're a product of the times. Decentralized tech is still kind of figuring itself out, and that'll take a while. So meme coins have kind of stepped in to offer some excitement in the short run. But a crash is going to purge these kinds of currencies from the system. Maybe not the biggest memes or the first coins to copy Bitcoin's code, but thousands of others. But the good news is this will lead to a new, better, long-term future for crypto. Even now, as so many people are sounding the death knell for crypto, I am totally confident that this will happen. But how can I be so confident? Because we've been here before. We've heard this story. In fact, we've heard it many times, but most recently, we've heard it in the 1990s. It's the early 90s, picture it. You're rocking your bomber jacket, plaid shirt, chain wallet, you're listening to Nirvana, Michael Jordan is the greatest athlete in the world, Seinfeld is the biggest show. Things were so simple, weren't they? And then you start hearing about this new thing called the internet. Now, maybe you've got some disposable income, you're a baby boomer living in the 90s, so you probably do. And sure, there are naysayers, people who think the internet is just some fad, something we'll look back on years from now as we rock our 28th generation beepers.
What is internet anyway?
But you don't feel that way. Sure, the internet might not look like much right now, all of it's text-based, ugly, not especially user-friendly, but you see the future. You see the underlying potential, the possibility of a connected world. You see what this is going to mean for everything, literally everything. So of course, this is where you should be putting your money. What could possibly go wrong? Well, as the 90s went on, with interest rates at their lowest point since the 70s, the internet quickly entered the mainstream. There were suddenly a lot of people creating these .com startups, and there were even more people who were looking to invest in them. This led to a massive increase in the equity markets, the greatest expansion of capital growth the country has ever seen. The NASDAQ index rose from under 1,000 to more than 5,000 in 5 years. Crazy, but a lot of this growth was due to speculative investing. People investing in companies not because of the profits they were making at the time, but because of the profits they could make in the future. Many investors and venture capitalists abandoned their cautious approach for this fear of not being able to cash in on the growing use of the internet. No one wants to be the loser who misses out on the internet.
Oh, that's
that little mark with the A and then the ring around it?
At See, that's what I said.
Because of this, marketing became extremely important. Many of the investors didn't even really understand what these companies did or how they planned to make money or how the internet was even going to evolve, so they found themselves highly susceptible to a company's marketing and PR. Startups understood how important this was, and they often abandoned any semblance of fiscal responsibility, focusing solely on doing whatever they could to gain investors and increase their valuation. Some startups spent as much as 90% of their budget on advertising. Sound familiar? A big part of the PR and marketing from these early startups was pushing this weird idea that it wasn't a problem if you didn't turn a profit. In fact, for a time, it became almost like a badge of honor if your startup wasn't making any money. It didn't turn people off or keep them from investing. It did the opposite. It meant that you were forward-looking. It meant that you were fearless. It meant that you weren't in this for temporary short-term gains, but that you were playing the long game. It meant that you were in this for the future. Just one example is Priceline, an online travel agency that for a time was one of the most sought after and highly valued companies on the planet. In March 1999, Priceline went public at $16 a share. On its first day of trading, it went up to $88 before settling down at $69. This gave Priceline a market cap of $9.8 billion, the largest first day valuation of an internet company to that date. However, at this point, Priceline as a company had racked up approximately $142 million in losses, but the investors didn't care. Priceline had a non-stop marketing blitz telling everyone it was one of the hottest .coms, and it worked. Expedia, one of Priceline's biggest competitors, was even quoted saying that they couldn't compete with Priceline because their business model required them to actually make money, which hurt their valuation. Just like there's been a rush in the past few years to create new coins and blockchains, there was a rush in the 90s to keep the pipeline of new IPOs coming, which led to a lot of companies that were founded on shoddy principles, but great at advertising to get the necessary heat to gain investors and grow in valuation. That's all that mattered. This happened over and over again. Want to know just how insane this speculation got? On March 10, 2000, the NASDAQ hit a record high of 5,048 points. A valuation that was 200 times as much as the company's underlying earnings. I don't use the word bonkers lightly, but this was pretty bonkers. And looking back at all this now, it's pretty easy to predict what happened next. By April 2000, just 1 month after it hit its peak, the NASDAQ had lost more than a third of its value. Over the next year, hundreds upon hundreds of these new, brilliant, cutting-edge, forward-looking, profit-agnostic internet startups saw their value drop by more than 80%. Priceline, the internet darling, absolutely cratered with a valuation dropping by 94%. It's difficult even now to track just how much money was lost during this period. Some sources put the number around 1.7 trillion, but that's only when it comes to public companies. The real number is much larger. In any case, a lot of people lost a lot of money. The public view of the internet transformed and most companies disappeared. These were companies that were founded at the dawn of the internet as we know it, companies that were ahead of the curve and sold themselves as being absolutely fundamental to our shared future, companies that today you've never heard of. That being said, there were a few that did survive. But why? Because they were strong and organized, because they possessed a genuine utility. They weren't just vapid marketing. If we look to the crypto industry today, we can see the earliest examples of the businesses that make the most sense. Exchanges. It's simple, they profit when people trade. And here's the thing. These bubbles don't just happen in tech. This pattern has occurred over and over again all throughout history. It happens pretty much any time there's a new advancement in human civilization. Real quick, let's jump further back in time to the dawn of the 20th century and the automobile. The horseless carriage was sold accurately as something that would transform all of our lives. Now, at first, building cars was insanely difficult and labor-intensive. You needed skilled mechanics and artisans to do it. But then a guy named Harry came along to help popularize the automotive assembly line. Almost immediately, manufacturing a car got a whole lot easier. And I bet you can guess what happened next. The exact same thing. In 1908, there were 253 active automobile manufacturers in America. By 1929, that number dropped to just 44. And even then, nearly 80% of the output was done by just 3 companies: Ford, General Motors, and Chrysler. It's the same story, the same rapid, over-enthusiastic gold rush mentality, the same expansive bubble, the same crash. It could be cars, .com startups, crypto, or Tamagotchis. It's all the same song and dance. But when it comes to crypto, we're painfully in the crash right now. But what came next with all these other stories, it's what's going to come next for ours, the recovery. It's so easy to feel down about crypto right now. It's been a difficult time for all of us. And it's so easy to fall victim to the negative talk from people who say this sector has cratered forever, who are even gleeful about it because they never invested in the first place, or maybe they just don't like the name Crypto.com arena. And yes, most junk cryptos will fail, but the tech still makes sense. After cheap money leaves the sector, we'll be left with a more solid, balanced, healthy market, with coins gaining in popularity not just because they're well publicized, but because they're credible, well designed, and made to solve a problem. Same as everything else, value always wins in the end.